The ECB has raised its key interest rate by an unprecedented 3 percentage points in just 7 months to fight runaway inflation. This is the first time the ECB has increased its interest rate since 2011, when it was at 1.5%. The current deposit rate is now at 1.5%, up from -0.5% in October. The ECB has signaled that more rate hikes are coming in the next few months, possibly reaching a peak in the first half of the ECB's aggressive tightening policy is aimed at preventing inflation from becoming entrenched and damaging the credibility of its 2% target. Inflation in the Eurozone hit a record high of 8.6% in October 2022, driven by soaring energy prices and supply chain disruptions. The ECB expects inflation to remain elevated for longer than previously anticipated, and its own survey of professional forecasters shows that inflation will stay above 2% until at least the ECB's rate hike plan has significant implications for the global economy, as it affects the exchange rate, the financial markets, and the growth prospects of the Eurozone and its trading partners. The euro has fallen to parity with the dollar for the first time in 2 decades, making Eurozone exports more competitive but also increasing import costs and inflation pressures. The bond yields in the Eurozone have surged, especially for the most indebted countries, raising their borrowing costs and fiscal risks. The ECB has announced a new anti-fragmentation tool to support bond markets and avoid a repeat of the sovereign debt crisis. The rate hike plan also poses a challenge for the Eurozone's economic recovery, which is already slowing down due to the impact of the pandemic and the energy crisis. The European Commission has cut its growth forecast for 2022 to 1.4% from 2.3%, and some analysts warn that a recession is possible if the ECB tightens too much too soon. The ECB's policy stance has also sparked criticism from some political leaders, who argue that it is exacerbating the downturn and hurting people's living standards. The ECB faces a difficult trade-off between containing inflation and supporting growth, and it may have to adjust its policy course depending on how the economic situation evolves. The ECB has stressed that its policy is data-dependent and flexible, and that it will monitor a range of indicators to assess the inflation outlook and the impact of its rate hikes. The ECB has also emphasized that its policy remains accommodative despite the rate hikes, as it still provides ample liquidity and stimulus through its other instruments. The ECB's rate hike plan has implications for the global economy, such as affecting the exchange rate of the euro, the borrowing costs of governments and businesses, the competitiveness of exports and imports, and the growth prospects of different regions. The ECB has raised its key interest rate by an unprecedented 3 percentage points in just 7 months to fight runaway inflation. It has also cut a key subsidy to banks and said detailed discussions on winding down the ECB's huge holdings of mostly government bonds will begin in December. Investors expect the ECB to increase the rate it pays on bank deposits from 2.5% currently to 4% by the end of the year. These moves have several consequences for the global economy. First, they make the euro more attractive for investors, as they can earn higher returns by holding euro-denominated assets. This pushes up the value of the euro against other currencies, especially the US dollar, which has fallen to parity against the euro for the first time in 2 decades. A stronger euro makes European exports more expensive and imports cheaper, which could hurt the trade balance and economic growth of the Eurozone. It could also affect other countries that peg their currencies to the euro or have close trade ties with Europe. Second, they increase the borrowing costs of governments and businesses in the Eurozone, as they have to pay higher interest rates on their debt. This could strain public finances and reduce fiscal stimulus, especially for highly indebted countries like Italy, Greece, and Spain. It could also discourage private investment and consumption, as loans become more expensive and households have less disposable income. Higher borrowing costs could also trigger financial instability, as some borrowers may struggle to repay their debts or refinance them. Third, they create a divergence in monetary policy between the ECB and other major central banks, such as the US Federal Reserve and the Bank of Japan, which have kept their interest rates near zero or negative. This could widen the gap in economic performance and inflation expectations between different regions of the world. It could also increase volatility in financial markets, as investors adjust their portfolios and hedge their risks across different currencies and assets. The ECB's rate hike plan is a bold attempt to contain inflation, which is running at a record high 8.6% in the Eurozone. The ECB argues that inflation is mainly driven by temporary factors, such as supply bottlenecks and energy prices, and that it will eventually fall back to its 2% target. However, some economists and market participants are skeptical that inflation is transitory and fear that it could become entrenched if wages and prices adjust upwards. The ECB faces a difficult trade-off between fighting inflation and supporting growth. It also faces political pressure from some European leaders who fear that its fast policy tightening could exacerbate the downturn and hurt their electoral prospects. The ECB has to balance these conflicting interests and communicate its strategy clearly and credibly to avoid market confusion and public backlash.